Welcome back to the Fostering Financial Victories podcast. My name is Eric Mazzell. I'm your host. Today I am joined by Jonathan McAdams. So we are going to give a bit of an update, kind of year to date on what the market has been doing. We are, September the 21st. So if you're listening to this, it'll probably be a few days after we recorded this, but had a pretty eventful day yesterday.
Yeah.
So we haven't done one of these recaps yet this year, so I thought this would be a good time to kind of dive into what's happened this year and kind of what we see going forward. So Jonathan, thank you for joining us. I know you got a busy day ahead, but
my pleasure. Give
everybody a quick kind of update on kind of where you got to this point in your career. How did you get here? Give some background.
Sure. No. Thanks. So I'm relatively new to Foster Victor. So my role is portfolio manager, but I've been doing this about 25 years. Started out in banking, went and got back and got my graduate degree, got my CFA, and then got into investment management with a large mutual fund in Texas. I did that for a couple of years. Ended up moving to Nashville to work with a hedge fund. So the gentleman I was working for at the mutual fund left and started a hedge fund in Nashville, asked me to come with him and did that with him. So we did a startup hedge fund, was an analyst on that fund for about 4 years, grew it to about $1 billion when I left. Went out on my own, started my own endeavor and launched a hedge fund and an RIA at the same time.
Wow.
And did that for a couple of years. That was September of 2008. So
great timing,
yeah. Good and bad, I guess, so to speak. But so we ended up having pretty good numbers, but obviously startup hedge funds, the world changed in 2008, particularly in financial markets. And so startup funds just weren't getting funded. So we ran the RIA a couple of years, so I ran portfolios for that. And then ended up kind of going our separate ways there. Met a gentleman through a mutual friend here in Greenville who said I was looking for a portfolio manager. So I came to Greenville about 6 years ago to be a portfolio manager with another firm in town. And then, like I said, jumped on the opportunity when one came up here to join you guys. So I'm excited to be here.
You've seen a few things.
I've been around. So I literally, so you talk about timing, I started my career, my first investment management job was summer of 2000. So right at the peak of the tech bubble.
Oh my gosh.
Started my own fund September of 2008. I mean, it's hopefully it's not the omen, me starting here.
Yeah.
So
all right. So if you could, man, we were talking through this yesterday as the market was kind of bouncing around a lot. I think the best place to start is just to give everybody kind of a summary of what's happened so far. So kind of year to date, where are we?
Yeah, so we've had a very strong market this year. The S&P is up about 17%. NASDAQ is up around the same. Dow's up a little bit lower. International stocks have lagged a little bit. But it's been a great year, and we have a good year in the market, coming off of a obviously volatile year last year. And so what you've seen is, the recovery is still in force. It's happening, and much stronger probably than a lot of people would have said even a year ago. And so you've had markets respond to the kind of continued reopening of the economy, and then economic activity has just kind of continued to heal and get better and get better. And the earnings results from that have really shown through the economy. So you've had a really strong backdrop economically and corporate-wise in terms of corporate earnings that's really driven the market higher this year.
So let's talk through the earnings a bit. I know there's been a lot of discussions this year with companies kind of blowing past estimates. What do you attribute that to? Do they just short-sighted a little bit on the front end and sandbag it some, or what?
Well, there's always an element of that. The companies always try to
tamp
it down and let the analysts let the estimates be lower so they can come in and beat it. But the magnitude of that this year has been remarkable. So you've seen at the beginning of the year, I think the estimated earnings growth for the S&P was just right around 20%, meaning they thought 21 would grow 20% more than 2020. Now, because now we've had the first 2 quarters report, that estimate is more like 42%. So we've had what people thought was almost a double in what they thought the growth would be this year. And so what you've seen is, you've had the market respond to that. And what you've seen is because of that earnings growth, you really haven't seen, multiples or what we call, PE ratios expand. You've actually had them contract, right? If if a PE is price over earnings and you've got the earnings really ramping higher, you've seen that PE come down actually because we've had such strong earnings growth. And so I think it's just, after the pandemic, I think everyone was scared and people kind of ratcheted down their, they just didn't know. We were kind of in uncharted territory in terms of what to expect coming out of this thing, right? We've never really just shut down an economy, cold turkey like that. And so I think naturally people were just conservative coming out of that and saying, look, there's still a lot of healing to be done. We're going to set our earnings estimates here, and and we've just done better than that. The vaccines, everything else has kind of opened up quicker than people thought. Return to somewhat normalcy has happened faster, so you're seeing that. And on top of all the stimulus that's gone out into the economy as well.
Sure. So the valuation, so you mentioned the price per earnings. That was something that last time that I did one of these recaps was with Rand, and we really spent a lot of time going through the PE ratios and is the market overbought? Is it overvalued? So what I'm hearing you say is that number is actually retreating some based on just all these earnings blowing estimates out of the water.
Right. If you looked at where earnings estimates were at the beginning of this year, the market was trading right around, call it 22, 23 times forward earnings. Right now we're sitting at 21. So you've actually had the PE ratio come down from 23 to 21, call it, here, because we've had such strong earnings this year.
Wow, I would not have expected you to say that. And we prepped for this. Okay, so the market having a good year thus far. What has been rewarded in the market? What have you seen from maybe a sector that's done well or not done well?
Right. We've seen it's really been kind of a tale of two markets this year. So what's unique this year is you haven't seen kind of that sustained sector leadership that you generally see in different parts of the cycle. What I mean by that, at the beginning of the year, we were having what I call the value rally. So everything cyclical, energy related, value, financials had a strong rally at the beginning of the year, kind of end of last year, beginning of this year through March. And so you had value really outperform. You had oil go from 45 to 70. And energy stocks were the top performing sector, going in through March, April. And so you had this kind of optimism around economic reopening, commodity prices were moving higher. And so you had all the value kind of leadership was pretty strong. And then you saw that switch kind of around March, April, where those stocks started to underperform. Growth started to then come back and outperform value. And really, year to date, it's kind of been a wash. You've actually seen value is still kind of ahead, but growth has really taken the reins over the past couple of months. A lot of that due to kind of somewhat of a slowdown. You had a reemergence of with the Delta variant. You had a reemergence of COVID cases come through the economy, and that sparked a lot of fears that maybe travel wasn't going to be quite as strong as we thought because of this reemergence. So you had kind of a shift in sentiment, kind of more defensive, more growth oriented in the market this year. So it's kind of been yin and yanging a little bit this year, as opposed to other years where you kind of have more of these more sustained cycles.
Okay, so I know that we talk about the jargon all the time. And I know our audience is super smart, so they probably know all this, but just can you give everybody a 30-second definition of what value stocks actually mean? What is that? Yeah,
value stocks simply are, and I talked about the PE ratio before, that's one metric that you use. So it takes a valuation framework, meaning for $1 of earnings that a company earns, what are you going to pay for that dollar, right? So a company that's growing slower, that maybe has more competition, you might pay a lower multiple of those earnings than you would somebody who's growing faster, 20%, 30% growth. You would expect to pay a higher multiple for that. And so growth and value just kind of delineates between that, where value are stocks that are sometimes cheap, or usually cheap on a PE ratio or other types of metrics, priced to something, price to cash flow or price to book, or some of these metrics. But price to whatever the asset is cheaper. There's more value there versus growth, which is companies that have much higher growth. You would expect to pay more for those types of companies, and so we try to kind of delineate between those two camps, and over time, you see these cycles kind of ebb and flow between the two.
Okay, thank you. All right, so let's get into some of the fun stuff, current events as we see what's going on now. So we're in September. Historically, has been the worst month of the market forever, it seems like. Why? Why is September so bad?
That's a good question. There's a lot of theories out there, I guess, and no one really knows. I think it is, people coming back from summer vacation. Volumes tend to go down over summer because traders and everyone kind of goes on vacation. Then you come back for September. Companies have a better read on what their year is going to look like. Kind of in September, they start traveling around and doing conferences and talking to investors, and so it's could be that, could be a time where companies kind of set the expectation. Here's where we think we're going to be at the end of the year, and there's no good theory behind. There's no good kind of reasoning behind it. That's the best one I can come up with. But it is true. I mean, it is fairly consistent. September, October generally are seasonally the toughest periods in the market. But
okay,
that's to why. That's a good question.
Yeah, haven't gotten a solid statistical answer just yet, but we're still looking for it, right? All right. So with everything that happened yesterday, today, kind of where the markets are going, pretty sensitive. Is it all stemming from China? What's going on?
Yes and no, I think is a good answer. When the markets, we've gone a long period in the market without a 5% pullback, almost a year, which is historically a pretty long period of time for the market to go without that amount of a pullback. So sometimes I think the market looks for the nearest available reason to go down. It's wanting to go down. It just kind of looks for, okay, let's grab a headline and make it down. Are the headlines in China real? Yes, absolutely. Those are kind of real concerns and real data points. So I think in some ways, yes, it is, it is important what's going on in China, and I think it has impacts. Is that the sole reason for the weakness? Maybe, maybe not. Maybe the market just needed to kind of let off a little bit of steam and just look for the next available headline. But what is going on over there, has some merit to it. There certainly is some concerns there, among some other things.
So, a couple weeks ago, we saw a lot of their unique industries get, maybe reined in some with some of the online companies that are based in China, with some of the direction from their leadership. Can you talk through where did that come from? Why did they decide to pick on these 4 or 5 companies all kind of out of the blue that were doing really, really strong?
Yeah. So China's kind of been in this, balance. They kind of have this capitalist model that, that they've let flourish over the past 20, 25 years. So you've seen kind of this pattern over the years where, the communist government will try to reassert itself, and kind of slap some industries on the hand. And you've seen this cycle before. I think what's different this time, and I think it is a little bit different this time, that it's not just kind of a slap on the hand. And so you've had kind of the longest period of kind of China tightening, so to speak, in a number of ways. And, a lot of the analysts I read, say that, this time, Xi is really saying, he wants to reassert control and use, kind of reorder things, so to speak, where, capitalism and some of these, large business owners kind of had the run of the place for a while. He's coming around and asserting kind of the communist, heavier hand on them at this point. And that may be something that lasts a while. I think he really views it as, a time to shift the economy potentially to a more kind of, more centrally planned, I guess. It's always been kind of centrally planned, but I think he's trying to swing that pendulum the other way and may try to keep it there.
A little more towards the government.
Right, towards the more government control. So he's kind of he's been picking out industries that they view as or issues in the economy that they view as kind of potentially causing social unrest, whether it be too much time youth spending gaming, so they go after the gaming companies. And then now you've got some rumblings, and they did it with Alibaba. They
and even before, when they were getting ready to spin off their financial arm.
Right.
What was it, last year, I believe it was.
Right. Jack Ma of Alibaba came out and kind of had some critical comments of the party, and we saw who won that battle.
And he kind of went MIA for a little while.
Yeah, and still is for so I think it's just a reassertion of the Communist Party's kind of control and dominance over the country.
Now, that's one aspect. So not connected really with the the piece that's going on in the news this week with the real estate company there.
Right. So the latest kind of news is obviously there's a company called China Evergrande, which is their largest property developer in China, but also the most indebted. And so where I say this is not, the market may be kind of using this as an excuse. The China Evergrande news has been kind of a slow-moving train wreck, meaning we've known about this in the market for months and months and months. It's been talked about. I've read about it. And so this is nothing new, but sometimes the market just grabs onto it. And
is it this week because of their pending interest payments, right?
That's right. So it's kind of coming to a head now. I think everyone's seen the warning signs. China Evergrande's gone from $25 in Hong Kong to $250 over the course of a couple of months
per share.
Okay. Right. And it was a $45 billion company, which is the size of Simon Property Group, which is the largest mall owner in the U.S. So it's not insignificant, but it's also not kind of massively systemic to China as well.
So how much debt do you think they're holding?
The estimates are they've got about $300 billion in debt that they have, and they've got about $100 million, I think, in interest payments that are coming due over the next week or so.
So $300 billion, and they're a $25 billion company, or were?
Right.
That ratio doesn't work too well.
Yeah. So it's a classic case of they, over the years they've kind of borrowed a lot to try to, they got into a lot of businesses that weren't just real estate development. They got into food and internet and electric cars, and they started to really expand. Classic case of just overexpansion, fueling that with debt, and now it's coming back to bite them. So now they're having to sell assets to try to raise capital, but. Whether the question, will China come in and bail them out? Maybe, maybe not. This is a real test for the Chinese government because they've, like I said, come out and said, hey, we're not going to kind of let the bad actors in our capitalist system, so to speak, run amok. And so, they may want to send a message here and say, no, we're not going to backstop. I don't think so. They may let China Evergrande kind of flounder. But I think if it starts to kind of bleed out into other property developers and more systemically into China, I think they probably will, do something.
So is that, I know I've seen some comparisons with Lehman Brothers back in the early 2000s. Is that a fair comparison with what the U.S. did?
I don't think it's apples to apples. I think it's, it certainly is a big, it would be a big failure or a big, event in the market. But I think the difference in, with Lehman Brothers and with financials in general is, the financials, when a financial goes under, it's because they've lost trust, right? A financial really has, a bank really has no assets. I have a couple buildings and branches, but really the asset is trust. I know that when I put my money in a bank, I'm going to be able to get it a year from now because they're going to be able to pay me back. But if people lose that confidence in a bank, then everyone, then you have a classic run on the bank, right? So that's what we had back then. Is what Lehman sparked was a kind of a classic run on the bank, meaning people lost trust in the financial system, started pulling money out, and then that kind of self-reinforces. But there's no real assets behind financials to kind of backstop that. Whereas with something like this, you do have, they do own physical real estate, right? There is some value there, something tangible that they have, and so it's not like you can just have this kind of massive loss of market confidence, and and things can evaporate. There is land, there is construction that's out there that people will want to own.
Okay.
So I think it's, does it have the potential to have ripple effects through the economy and through the globe? Yes, but I don't know that this is the Lehman moment that we saw in 2008.
Okay. All right, so let's move to a little bit more of a hotter topic with the inflation discussion. However you want to interpret the word transitory, we can talk through that. There's a lot that's going on in the next couple weeks. I know this week's kind of starting some of it with the Fed for monetary policy. What's your take there? What do you see them potentially talking about and maybe doing?
Yeah, I think they're going to, the party line, and the kind of $64,000 question is we've seen higher inflation. We have kind of higher inflation statistics. The Fed has come out and said, we think that's transitory, which justifies them keeping rates low and keeping monetary policy very relatively lax. And so that is the key question. So I think they're, and they've kind of expressed a willingness to say, hey, we're willing to let inflation run a little bit hotter than normal in an attempt to try to get employment numbers back to where we want them, right? The Fed has a dual mandate, right? They have to keep prices steady, and they need to reach full employment. And so it's sometimes it's a balancing act. So they're saying, look, we're willing to give up a little bit of inflation to try to get employment back to where we need it to be. And so I'll probably make similar comments. I don't think, doesn't sound like, there's probably not going to be any move on rates. What people will be watching for is language around when are they going to start tapering, meaning they're...
Okay, what does that mean?
So tapering means, so the Fed, in addition to, moving rates to zero, they are also in the market buying treasury bonds and mortgage bonds, to the tune of about $120 billion per month.
Oh, say that one more time.
$100 billion, that's with a B.
$120 billion
Right.
a month. Okay.
Right.
So that's how much money is essentially getting pushed into the market from the Fed.
Right, that's
Okay.
right. That's not a new phenomenon. They've been
Right.
doing that since 2008, but they did ratchet back up. They started to, so when you hear the word tapering, all that means is a slowing down or a reduction in the pace of that buying. So they may go from $120 billion a month to 100 to 80 to 60 eventually, we'll see. But so when you hear that word, that's what it's talking about. So the expectations are, it may or may not be this meeting, but certainly probably this fall, they're going to signal kind of where, what that tapering looks like and when. And so I think Mark is expecting that. I don't think that's going to be a surprise, but people will be, looking to see whether that's more aggressive or less aggressive than where the market was thinking. So we'll see what he says on that. And then they'll also be watching, people are still watching, it's still going to be, the market, the last Fed meeting, the Fed went from, hey, we're not going to raise rates till the beginning of 2023. Well, then they, after that last meeting, they said, well, that might be, the end of 2022. And so the market kind of wiggled a little bit around that. And so they'll be looking for kind of where the expectations are when that first rate hike is going to happen.
Okay. So a lot of folks typically, historically would say from a what do you do with a high inflation perspective. I know we talked a little bit about what gold has always been looked at, and we've got that question a lot. With cryptocurrency now being, at least on the forefront of what people are talking about, what do you see as the asset where dollars may be moving? Not saying that that's the right way to go, but kind of what's your take on that piece? Is it replaced each other, or is it kind of similar, or what?
As far as gold versus crypto?
Yeah, because that's kind of been the argument.
Yeah, it's hard to know exactly, but I think there has been an argument made that they call Bitcoin kind of the digital gold in the sense of it's potentially a store of value just like gold is. And so you have seen gold make a move kind of last year. It's kind of been flat this year while crypto has really moved higher. And so the theory is, well, maybe crypto is the new, Bitcoin is the new gold. Maybe not, it's hard to know. But I think, they both kind of serve that role as people looking for alternative stores of value versus the dollar. So Bitcoin serves that function, I think, and that is a large piece of why people buy it. But it is also speculative. I mean, we saw yesterday, Bitcoin was down, 5-6%.
Sure.
Just because it was risk off yesterday. So whereas gold was up yesterday. So, it kind of has, kind of takes on different faces depending on which day it's trading. But gold kind of has historically been, one, an inflation hedge, and two, kind of a safety in a storm kind of
Got
concept.
it. Probably way more relevant when we were actually on the gold standard.
Right. So, right. All of that changed kind of in the 70s when we came off the gold standard, obviously. And that really was kind of the spark that really let gold do its thing in terms of being, an inflation hedge. So, definitely the dynamic has changed over the years.
Okay. So far, 2021, a lot of things have been moving. Surprises that you have seen that we haven't talked through yet? Anything that kind of stuck out? You thought, man, I didn't see that coming.
No, I think we've touched on probably the two that were the biggest to me in terms of, did I think the earnings results would come in as strong as they have? No. I think as long as and I think the testament of what those revisions have been over the year speak to that lots of people were surprised that companies have been doing as well as they have. I think the others, I'd say the other big surprises, we really just haven't had that sector leadership. We've kind of been, like I said, kind of going between growth and value, and nothing's really kind of stepped into the market to say this is really the trend that's happened. So other than that, I think that's those are probably the two biggest that I could probably say have.
So kind of looking at the leading sectors and the ones that may be lagging some. Real estate's up 29%. That's the top. And then you have energy at 28, and then financial services at 25. And on the bottom, you had consumer staples at 6%, utilities at 7.3%. So there's a lot of ways you can interpret that. I look at it to say, well, the one who's doing the worst is still up 6%.
Right.
Right. So it's still not, the worst is still not that bad.
Right.
But you kind of talk through how those have shifted throughout the year?
Yeah, it's what that dynamic you just mentioned is what you would expect in a recovery year, right? Staples are a defensive category, meaning they're the things that you want to own when you're worried about the market or there's a downturn. Whereas the sectors you just mentioned are, pro-cyclical or sectors that do well in an upturn. And like I said, the energy, some of those names, they were up 45, 50%. They've kind of come down. But they're still kind of leading the year because we've still been in this kind of recovery mode.
Got it. All right, so we talked through just trends and following the money. All right, so this is probably the way that we can wrap this up, but inflows and outflows of, bonds, stocks, mutual funds, those types of things, money market accounts, what are you seeing?
So what you've seen over the past several years, kind of the longer tail history, is you've seen kind of a massive inflows into bonds, which you would think, well, with rates where they are, why are people doing that? And it is kind of, it is an interesting dynamic. And you've seen outflows in equities. This year, you've seen a little bit of turn, meaning bonds are still getting a lot of the flows, but you've seen money start to flow back into equity funds. And this is, obviously there was a lot of equity outflows last year, and then kind of choppy the years before, some years positive, some years negative. But certainly bonds have gotten the lion's share of the fund flows. But this year you've started to see people get back into equities. Interestingly, you've seen international funds really start to collect some money. So international funds are the strongest equity subcategory. Or international funds are the strongest equity subcategory this year. I think people looking for opportunity, a lot of times those fund flows are backward looking, and in a way they are, but sometimes, like this year where, international equities have underperformed the U.S. for the past 9 or 10 years. I mean, a very long underperformance track record. And I think you're starting to see a lot of people see value there because you've got valuation spreads between the U.S. and international are as wide as they've ever been. And so people are kind of saying, okay, things feel a little frothy here in the U.S. Can I find some value internationally? And you're starting to see money flow that direction. But you're still seeing, in terms of, and then you got cash as your other large asset, right? And so you've got cash levels, money market funds are at, just under $5 trillion, which is a massive amount of money when you think about it. Kind of where we were pre-pandemic was about $3 trillion or so. So wow. We've had a $2 trillion increase in money market funds. So there's a lot of dry powder out there sloshing around, for the market to move higher, if people, get more comfortable.
A lot of dry powder ready to go.
Mm-hmm.
Yeah.
Mm-hmm.
Okay. All right. So, Jonathan, is there anything else that you feel like we need to kind of dive into? I feel like we've kind of touched on a lot of different topics and a lot of different angles of the market, but anything else you kind of as a recap?
Yeah, no, I think the summary would be, look, we've had a great run in the market. We're 100%, the S&P is 100% off of the lows from the lows of the pandemic last year. We're 25% higher than we were pre-pandemic, even from those highs. So we've had a very good run in the market. We're on the expensive side, so it's things aren't cheap, but you've also had the underlying cash flows and earnings that we talked about come alongside of that and really justify kind of the move in the market. And so the question is, are we, are we probably due for some kind of correction? Potentially. Market has a 5 to 10% correction, almost every year. And it's been a year since we've had even a 5%. So I would not just be surprised to see something, but you never know. But I don't think it changes the narrative of, we're still in an economic recovery. It's hard to make a case for where we would have a flashpoint for a recession. You typically don't have recessions. You have recessions because you have excesses somewhere in the economy that need to be let out, whether it be real estate or, tech bubble back in the 2000s. Right now we have shortages. We can't get enough of things. And so it's hard to make a case that we've got too much of something somewhere when we can't even get, products to the customers that they need now. I just had to buy a car, and it took me a week of calling 4 major cities to try to find a new car that I could get. So
and you kind of flipped the car is not an investment argument on its head.
Oh yeah. So
just share that with
I sold I sold a car to we're kind of downsizing our vehicle. So I sold a passenger van that I had.
By the way, he has 7 kids.
Yeah. Okay. So I have a passenger van because I have 7 kids. So we decided to sell it. My wife wanted to drive something a little bit smaller, and so I literally sold a 12-seat passenger van 15% higher than I paid for it 2 years ago.
That's pretty good. That's pretty good.
So I'm giving up stocks and going into these cars.
Yeah, pretty good. All right, so let me wrap this thing up. There's a couple things. So Jonathan, everybody who's been on this podcast as a guest, you've gotten the same 2 questions. So I'm gonna give them to you. If you could buy anything in the world, regardless of what it cost, what would it be?
Oh wow.
Put you on the spot.
Yeah.
Probably wouldn't be a 15-passenger van.
No. If I could buy anything in the world, regardless of cost.
Yeah.
Oh, man. And so, like an asset? Like some
whatever you want.
Whatever I want?
Whatever you want.
I don't know, probably just, gosh, I don't know. Make sure my family is taking care of college and my immediate family, make sure their living situation was good and,
Others focused.
Definitely take care of the family, that's for sure,
right.
Whatever that would cost.
So last 2 things you spent money on.
Oh, gosh. Last 2 things I spent money on. Probably, let's see. Well, I just bought a van, so just bought a new car, so that's certainly my biggest ticket here recently, so that was a little painful.
But you made money. Yeah,
I did. Right. We'll see on the new car. But
there you go. Well, man, thanks for spending time with us on this. Appreciate your insight. Everybody, I appreciate you dialing in and joining us today. If you've got questions or concerns or suggestions on things that you'd like for us to cover in any future episodes, you can find us on our website at fostervictorwa.com. You can also follow us on Instagram at Foster Victor Wealth Advisors. Share this with a friend. Hope to see you back next time. Thanks. Information contained in this podcast was intended for general use, not to be used as specific advice. For content tailored to your personal situation, please contact one of our wealth coaches.